Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This presentation is for educational and informational purposes only. The information provided is not intended as financial, legal, or tax advice. You should always consult with a qualified professional before making any decisions about your personal financial situation. Let me tell you a story about a couple named Mike and Jessica. They were in their early 30s, had a 3-year-old daughter, a mortgage on a house in a nice suburban neighborhood, and a second baby on the way. Life was chaotic, beautiful, and full. They talked about life insurance, of course. It was on their to-do list, somewhere between finally clean out the garage and plan a vacation we'll never have time to take. They figured they were young, healthy, and had plenty of time. It was a problem for future them. Then, one Tuesday afternoon, the unthinkable happened. Mike, a perfectly healthy 34-year-old, was in a car accident on his way home from work. He didn't survive. In an instant, Jessica's world didn't just shatter emotionally. It imploded financially. Suddenly, she wasn't just a grieving widow and a single mother. She was a single mother facing a 30-year mortgage, 2 car payments, looming daycare costs, and the dream of a college education for her children, all on a single income. The financial safety net she and Mike had always assumed they'd have time to build simply wasn't there. This story is tragic, and it's terrifying, but it is not unique. Every single day in America, families are pushed to the brink of financial ruin because of a single unexpected event. And the hard truth is, for so many of them, it was entirely preventable. That's why this video exists. This isn't just another boring lecture about a financial product. This is a complete guide, a roadmap designed specifically for parents like you, to demystify one of the most important financial decisions you will ever make for your family. We are going to cut through the confusion, the jargon, and the bad advice to give you a crystal clear understanding of what life insurance is, how it works, and exactly what you need to do to protect the people you love most. By the end of this guide, you will be able to confidently answer the 3 most critical questions. How much coverage do I actually need? What type of policy is right for my family? And how can I get the best possible protection without breaking the bank? You will walk away with a plan. Now, I know what might be going through your head. You hear life insurance and you immediately think of 3 things. It's morbid, it's complicated, and it's way too expensive. Let's tackle those right now because they are the biggest myths that stop parents from taking action. First, the idea that it's morbid. Talking about what happens after you're gone is uncomfortable. I get it. But let's reframe this. Life insurance isn't for you. You won't be here. It is for them. It is for the people who are left behind. It is the ultimate act of love and responsibility. It's a plan for their continued life, not a plan for your death. It's the plan that says, even if I'm not here, my love and my support for you will be. The house will be paid for. You will be able to stay in your school. Your dreams are still on track. It transforms a conversation about death into a powerful plan for life. Second, that it's too complicated. The industry loves to make it seem that way with confusing terms like whole life, universal life, riders, and premiums. It feels overwhelming, and when we're overwhelmed, we do nothing. That's why we're here. I'm going to translate all of that into plain, simple English. We'll use analogies you can actually understand. We're going to make this simple. Promise. And the biggest myth of all, I can't afford it. This is the #1 reason people give for not having coverage. A recent study showed that more than half of Americans overestimate the cost of life insurance by 3 times or more. Millennials, your generation, overestimated the cost by over 5 times. They think a healthy 30-year-old is paying hundreds of dollars a month for a standard policy. The reality? That same healthy 30-year-old can often get a 20-year, $500,000 term life insurance policy for about the cost of 2 large pizzas a month. Maybe less than your Netflix and Spotify subscriptions combined. For the price of a few cups of coffee a week, you can ensure that your family has $500,000 to see them through the worst time of their lives. When you see the actual numbers, the question changes from "can I afford to have it?" to "can I possibly afford not to?" Another huge mistake I see parents make is thinking, "I'm covered at work." And while having group life insurance through your employer is a great perk, relying on it as your only safety net is one of the most dangerous financial traps you can fall into. Here's why. First, the coverage is almost never enough. Most employers offer a policy that's a small multiple of your salary, maybe 1 or 2 times. Let's do the math. If you make $80,000 a year, a one-time salary policy gives your family $80,000. How long will that last? After a funeral, paying off a few debts, how many mortgage payments does that cover? 6 months? A year maybe? It's a bandage, not a solution. It's not designed to replace your income for the 15 or 20 years your kids will still be depending on it. Second, and this is the critical part, you don't own that policy. Your employer does. What happens if you change jobs? You lose it. What happens if you get laid off? You lose it. What happens if you get sick and can no longer work? You lose the insurance right when your family needs it most. And by then, because you're older or have a new health condition, getting your own private policy could be drastically more expensive or even impossible. A private policy that you own stays with you no matter where you work, as long as you pay the premium. It is your family's permanent safety net, controlled by you and you alone. So let's establish the foundation. What are we actually talking about here? At its core, life insurance is a simple contract. You pay a regular fee called a premium to an insurance company. In exchange, the company promises to pay a large tax-free lump sum of money called the death benefit to your chosen person, your beneficiary, if you pass away while the policy is active. That's it. That's the core of the machine. It's a way to create an instant financial estate for your family for pennies on the dollar. You are leveraging a small, manageable amount of money today to guarantee a large, life-changing amount of money for your family's future. Now, all life insurance policies fall into 2 main categories. Understanding this difference is the absolute first step. Think of it like deciding between renting a home and buying a home. The first category is called term life insurance. This is the simplest, most popular, and most affordable type, and it's like renting. You get protection for a specific period of time or a term, typically 10, 20, or 30 years. If you pass away during that term, your family gets the payout. If you outlive the term, the policy simply expires and there's no payout. It's pure, no-frills protection designed to cover you during your most vulnerable years. When your kids are young, your mortgage is high, and your income is critical. The second category is called permanent life insurance. This, as the name implies, is designed to last your entire life. And it's more like buying a home. It's more expensive than term insurance, but it serves 2 functions. It has the death benefit, just like term, but it also includes a savings or investment component called cash value that grows over time. It's more complex, comes in different forms like whole life and universal life, and serves different financial goals. Both have their place. Both can be powerful tools, but they are built for very different jobs. Choosing the wrong one is like trying to use a hammer to drive a screw. You might get it in there, but you'll make a mess and it won't be as secure. The vast majority of financial experts agree that for most young families, the primary need is income replacement, and the most efficient and affordable way to get that is with term insurance. But this is where the path splits. This is where people get confused by the options and paralyzed by the choice. Term or permanent? How do you decide? And if you go with term, how long should that term be? 10 years? 20? 30? Making the right choice here is the foundation of your entire family's financial security plan. And getting it wrong can cost you tens of thousands of dollars and leave your family exposed when they need protection the most. So how do you get it right? How do you look into the future and pick a number, 10, 20, or 30 years? That could literally define whether your family thrives or collapses after you're gone. Feels like guessing. Feels impossible. But it's not. There is a simple, powerful framework you can use right now to find the perfect term length with near mathematical precision. It's called the dependency timeline. The single biggest mistake people make is thinking that life insurance is supposed to last for their whole life. It's not. At least not the kind that most families actually need. The correct name for the life insurance we're talking about is actually term life insurance. And the key word there is term. It's designed to protect your family for a specific period of time, the period when they are most financially dependent on you. Your goal isn't to stay insured forever. Your goal is to stay insured until your family can stand on its own 2 feet without your income. Once they can, the need for life insurance, it just evaporates. You've won the game. So, your entire decision boils down to one question. How long will my people be dependent on my income? Let's map it out. Think about your youngest child. Or if you're planning on having more kids, the child you haven't even had yet. This is the anchor point for your entire timeline. The clock starts now, and it doesn't stop until that last child is financially independent. So what does that look like? For most of us, it means getting them through college and into their first job. Let's be conservative and say that's around age 22. Some might argue 25, and that's fine too. The point is, you need a finish line. Let's take a hypothetical couple, Mark and Sarah. They're both 30 years old, they just had their first baby, a little girl named Amelia. They're sitting at their kitchen table, overwhelmed, looking at life insurance quotes. They see options for 10, 15, 20, 25, and 30-year terms. Mark's first instinct is to go with a 20-year term. His logic seems sound. Amelia will be 20 years old when the policy expires. She'll be in college, almost an adult. We should be fine. Sarah nods along, it makes sense. It's also cheaper than a 30-year term, and with the cost of diapers, every dollar counts. This is the single most common and most devastating mistake young parents make. They've forgotten about two critical factors. First, what if they have another child? Let's say in 3 years they have a little boy named Leo. Mark and Sarah will be 33. When their 20-year term policy expires, they'll be 50 years old. Amelia will be 20, yes. But Leo? He'll only be 17. He'll be a junior in high school. He will still be 100% financially dependent on them. If something happened to Mark in that 21st year, Sarah would be left with a teenage son to raise and put through college, all without Mark's income. The insurance they so carefully paid for over 2 decades would be gone. Worthless. They would have a 5-year gap of maximum vulnerability. Trying to buy a new policy at age 50 to cover that gap would be astronomically expensive, if they even qualify at all. A health issue that's a minor inconvenience at 30 can make you uninsurable at 50. This is why, for most parents in their 20s and 30s, a 20-year term is a trap. The small amount you save per month is not worth the catastrophic risk of leaving your family exposed. The second factor Mark and Sarah missed is the other side of the dependency equation: their own financial independence. It's not just about the kids. The life insurance is also there to protect the surviving spouse. Let's rewind. Mark and Sarah are 30 with baby Amelia. They also just bought their first house with the classic 30-year mortgage. See where I'm going with this? A 30-year mortgage and a 30-year term life insurance policy are a financial match made in heaven. If Mark passes away at age 45, in the middle of that 30-year term, Sarah can use a portion of the life insurance payout to completely eliminate the mortgage. Instantly, the single largest monthly expense most families have is just gone. Forever. This gives the surviving parent incredible breathing room. It ensures they and the kids will never ever lose their home. A 20-year term doesn't align with this. It would expire 10 years before the house is paid off. But it goes even deeper. The insurance is a bridge. It's a bridge to retirement. Imagine Sarah, now 45 and widowed. Not only is the house paid off, but the rest of the insurance money replaces Mark's income. This means she doesn't have to raid their retirement accounts to pay the bills. She can continue to work, save, and invest for her own future. The insurance money acts as a stand-in for Mark's paycheck, allowing their long-term financial plan to stay on track. Now let's look at the 30-year term option. Mark and Sarah buy it at age 30. It will expire when they are 60. By the time they're 60, what does their life look like? Amelia will be 30, and Leo will be 27. Both are long gone, financially independent, maybe even with kids of their own. Their 30-year mortgage, which they got at age 30, will be completely paid off. And at 60, they are on the doorstep of retirement. Their 401(k)s and other investments have had 30 years to grow and compound. At this point, they are what we call self-insured. If something happens to Mark at age 61, Sarah is financially secure. The house is paid for, the kids are on their own, and they have a nest egg they can live on. The need for that multi-million-dollar life insurance policy has vanished. They successfully used the 30-year term to protect their family during the long, vulnerable middle years. This is the goal. You are buying time. You are buying a 30-year window for your kids to grow up, your mortgage to be paid down, and your retirement accounts to mature. So who are these 10 and 20-year policies for? They're for people in different situations. A 10-year term might be perfect for a 55-year-old who just needs to make sure their spouse can get to full retirement age. A 20-year term might work for a 45-year-old whose kids are already in middle school. But for a 30-year-old starting a family, it's like buying a parachute that's designed to open 500 feet above the ground. It might work, but you're cutting it dangerously close. You might see some financial gurus online talk about a complex strategy called laddering, where you buy a 10-year, a 20-year, and a 30-year policy all at once, with the idea that your need for coverage decreases over time. In theory, it makes some sense. In practice, for 99% of people, it's a needlessly complicated mess that saves you a trivial amount of money per month while dramatically increasing the chances you mess something up. Simplicity is your friend. One solid 30-year term policy is the clean, simple and effective answer for the vast majority of young families. So let's bring it all back to you. Pull out your phone and open the calculator. Take your current age. Now think about your youngest child or when you might have your last child. Add 22 years to their current age, or 22 years to the future age of that planned child. How old will you be? Is it less than 30 years from now? Don't forget to add a buffer of a few years for unforeseen circumstances, or if you have another child later than planned. For almost everyone starting a family, the math will point directly and overwhelmingly to a 30-year term. It's the safest, most comprehensive option. It aligns with your mortgage. It protects your spouse all the way to the brink of retirement. And most importantly, it covers your children through their entire dependency with a buffer to spare. The peace of mind that comes from knowing you have an uninterrupted shield of protection for 3 decades is priceless. And the cost difference between a 20-year and a 30-year term when you're young and healthy is often shockingly small. We're talking about the price of a few cups of coffee a month to buy yourself an extra decade of ironclad security. It is the single best bargain in the entire financial world. So we've solved the how long question. For most parents, the answer is 30 years. Lock it in. But that just leads to the next, even bigger question. How much? How much coverage is enough to actually protect your family? Is it 500,000? A million? 5 million? How do you pick a number that will truly replace your income, pay for college, destroy the mortgage, and secure your family's future without leaving them short or making you insurance poor right now? The way most people calculate this is completely wrong. But there's a simple formula you can use to find the perfect number. And the answer is going to be a lot bigger than you think. So, how do we find that magic number? The one that truly protects your family? Most people turn to an old tired rule of thumb. You've probably heard it. Just get 10 times your annual salary. Sounds simple. Sounds reasonable. And it is dangerously, completely, and utterly wrong. Following that advice is like packing for a 20-year Arctic expedition with nothing but a light jacket and a sandwich. You are setting your family up for failure. Why is it so bad? Because it ignores reality. 10 times your salary doesn't account for your 30-year mortgage. It doesn't account for your 2 car payments or the $20,000 in student loans you're still chipping away at. It completely ignores inflation, which we all know is a silent thief that makes $1 today worth much less in 10 or 20 years. And most critically, it completely ignores the massive future expense that keeps parents up at night. College. That rule of thumb is a relic from a different economic era. And clinging to it is one of the biggest financial mistakes a parent can make. So let's burn that rule to the ground and replace it with something that actually works. A simple, powerful framework that a lot of financial planners use. It's an acronym called DIME. DIME. It stands for debt, income, mortgage, and education. This isn't just a formula. It's a fortress. It's how you build a wall of financial security around your family, ensuring that if you're gone, their world doesn't crumble financially. Let's break it down piece by piece. First, D is for debt. This is the starting point. We need to wipe the slate clean for your surviving partner. I want you to add up every single penny of non-mortgage debt you have. Think car loans, credit card balances, student loans, personal loans, any money you owe to anyone for anything. The goal here is immediate relief. Imagine your spouse, in the midst of the worst time of their life, getting a notification that the $15,000 car loan has been paid in full. The credit cards are at zero. The student loan burden is gone. That's not just financial freedom. It's a massive emotional weight lifted, allowing them to grieve and focus on the kids without being hounded by creditors. Next, I is for income. This is the big one. This is where the 10 times salary rule completely falls apart. We need to replace your income not for a decade, but for as long as your family will depend on it. The most common way to calculate this is to figure out how many years it is until your youngest child turns 18, or even better, graduates college around age 22. So, if you make $80,000 a year and your youngest is 3, you need to replace that income for the next 19 years. 80,000 times 19, that's over $1.5 million. Right there. Just for income. And this is where we have to have a serious talk about stay-at-home parents. The 10 times salary rule assigns an economic value of 0 to a parent who isn't earning a W-2 income. This is not just insulting, it's financial malpractice. If you have a stay-at-home partner, what would it cost to replace everything they do? Childcare, for one, is astronomically expensive. We're talking tens of thousands of dollars a year. But it's more than that. It's cooking, cleaning, driving kids to soccer practice, managing the household finances, helping with homework. To hire people to do all of that would easily cost $50, $60, maybe $70,000 a year or more. So when you're calculating the I for income, you must include a policy on the stay-at-home parent that replaces the massive economic value they provide. Their contribution isn't a luxury. It's the engine that makes the family run. Third M is for mortgage. This one is simple and beautiful. The goal is to pay off the house. Period. Take the remaining balance on your mortgage and add it to the total. Why? Because the single greatest source of security you can give your family is a permanent, paid-for roof over their heads. It means they won't have to move. The kids won't have to change schools or leave their friends during an already traumatic time. It means that no matter what other financial storms may come, they have a home, a sanctuary. That is priceless. And finally, E is for education. For so many of us, this is a core part of the dream we have for our children. We want to give them a head start, an opportunity to pursue their passions without being shackled by a mountain of student debt. So you need to be realistic about this. How much will college cost when your kids are ready to go? A safe estimate these days is to budget at least $100,000 per child for a 4-year degree at a public university. For a private school, that number could be double or triple. So, if you have 2 kids, you need to add another $200,000 to your total just for their education. This is you fulfilling a promise to them, even if you're not there to see them walk across the stage. So let's put it all together with a quick example. Let's take a hypothetical couple, Mark and Jessica. Mark earns $90,000 a year. Jessica is a stay-at-home mom. They have 2 kids, ages 4 and 7. Let's run the dime formula for Mark. D for debt. They have a $20,000 car loan and $10,000 in credit card debt. That's $30,000. M for mortgage. They have $300,000 left on their house. E for education, 2 kids, so let's budget $100,000 each. That's $200,000. And I for income. Their youngest is 4, so they need to replace Mark's income for 18 years, until she's 22. 90,000 times 18 is $1,620,000. Now we add it all up. 30,000 plus 300,000 plus 200,000 plus 1,620,000. The total life insurance Mark needs is $2,150,000. $2.15 million. Take a breath. I know, that number is a shock. Feels impossibly large. It sounds like a Powerball jackpot, not an insurance policy for a regular family. Your brain is probably screaming, there is no way I need that much, and there is absolutely no way I could afford it. This is the moment where most people get scared, they throw their hands up, and they either do nothing or just buy a small, inadequate policy that provides a false sense of security. But here's what you have to understand. The goal of that $2 million policy isn't to make your family rich. It's not so your spouse can go buy a Lamborghini. The purpose of that money is not to be spent. It's to be invested. Think of it like this. You're not just leaving behind a pile of cash. You are leaving behind a financial machine. A machine that, when invested conservatively in simple low-cost funds, is designed to generate a paycheck every single year to replace the one you're no longer bringing home. It allows the principal, that big $2 million number, to stay mostly intact, providing stability for decades. It's the endowment for your family's future. And there's one last step. Once you have that big scary number, you get to subtract what you already have. Do you have $50,000 in savings? Great, subtract that. Do you have $200,000 in your 401k? Subtract that. Do you already have a small $100,000 policy through your job? Subtract that too. This dime formula gives you your family's total need. Then you subtract your current assets to find your actual life insurance gap. For most young families, that gap is still going to be well over $1 million. So you have your number. It's big, it's specific, and it's real. But now comes the most important question. How on earth can a normal family afford $1 million or $2 million policy? The price tag is probably the biggest myth of all, and in the next part we're going to shatter it. You're going to see just how little it can cost to protect your family's entire future. So let's talk numbers. Real numbers. Forget the vague estimates and the scary figures you might have in your head. What does it actually cost for a young family to be properly protected? Let's build a real-world example. Meet Mark. Mark is 35 years old. He's a dad to 2 young kids, a 7-year-old and a 4-year-old. He works a desk job, he's in good health, doesn't smoke, and tries to hit the gym a couple of times a week. He's a completely normal average guy. Mark and his wife figured out they need a $1 million policy to make sure his family would be okay if he were gone. That's enough to pay off their mortgage, cover the kid's college education, and replace his income for over a decade. $1 million. Sounds like a fortune. So the policy must cost a fortune, right? What if I told you that for Mark, a 35-year-old in good health, a $1 million policy with a 20-year term could cost him around $50 a month? $50. Let that sink in. That's less than the average family's monthly streaming subscriptions. It's less than a weekly trip to Starbucks for two. For the price of a couple of pizzas, Mark can guarantee his family $1 million if the worst should happen. Suddenly, it doesn't seem so impossible, does it? The biggest barrier for most people isn't the actual cost. It's the perceived cost. A study by an industry group found that most people, especially millennials, overestimate the cost of term life insurance by more than 3 times. Some even thought it was 5 or 6 times more expensive than it actually is. So why is it so affordable? And what factors actually go into that $50 a month price tag? There are 4 main levers that determine your cost: your age, your health, the length of the policy, and the amount of coverage. First, age and health. These are the big ones. Life insurance is all about risk. The younger and healthier you are, the lower the risk you pose to the insurance company, and therefore the lower your price. When you apply, the insurance company will look at your medical history, your family's medical history, your height, your weight, and they'll likely require a simple medical exam. Based on this, they place you into a health category. Think of it like a letter grade in school. The top tier is usually called something like Preferred Plus or Super Preferred. This is for people like our friend Mark, non-smokers in excellent health. This gets you the absolute best rates. But what if you're not in perfect health? What if you have slightly high blood pressure that's managed with medication? Or you're carrying an extra 20 pounds? You don't have to be a super athlete to get affordable coverage. You might just fall into a standard health class instead of preferred. For Mark, instead of $50 a month, a standard rate might be closer to $80 or $90 a month. Yes, it's more, but it's likely still far less than you imagined. It's still an incredible bargain for $1 million safety net. The second lever is the term length. This is a critical concept to understand. We're talking about term life insurance here, which is the most common and affordable type for parents. Term simply means it covers you for a specific period of time, typically 10, 20, or 30 years. You choose the term that matches the length of your biggest financial obligations. For most parents, that's a 20 or 30-year term. You want the policy to last until the kids are grown and financially independent, and the mortgage is paid off. A 20-year term will be cheaper than a 30-year term for the same person and coverage amount. Why? Because the insurance company's risk of having to pay out is lower over a shorter period. For Mark, that $1 million policy for 20 years was $50. If you wanted to stretch that to a 30-year term, to cover his family until he's 65, the price might go up to around $75 or $80 a month. He gets an extra 10 years of protection for a small increase in his monthly payment. It's a trade-off you get to decide on. The third lever is the coverage amount, also called the death benefit. This one is simple: the more coverage you buy, the more it costs. A $2 million policy will cost more than a $1 million policy, but it doesn't necessarily cost double. Because of how the pricing is structured, going from $1 million to $2 million in coverage might only increase Mark's monthly cost from $50 to, say, $95. You get double the protection for less than double the price. So let's put it all together for Mark's family. Mark, age 35, gets a $1 million, 20-year term policy for $50 a month. But what about his wife, Sarah? She's 34, also in great health. She's a stay-at-home parent right now, but her contribution to the family is immense. If she were gone, Mark would have to pay for full-time childcare, a housekeeper, and a million other things. So they decide she needs $1 million policy too. Because women have a longer life expectancy than men, their rates are typically lower. Sarah's $1 million, 20-year policy might only cost around $40 a month. So now, for a combined $90 a month, both Mark and Sarah have their own separate $1 million life insurance policies. Their family is protected with a $2 million safety net. $90 a month. That's the reality. That's the number that shatters the myth that life insurance is only for the wealthy. Now you might be thinking, that's great for a healthy 35-year-old, but what about me? Let's look at a 45-year-old. Age is the one factor you can't control, and it's the biggest argument for not waiting. If our friend Mark waited 10 years until he was 45 to buy that same $1 million 20-year policy, his monthly cost wouldn't be $50. it would likely be closer to $130. It's still a fantastic value, but he would have paid significantly more over the life of the policy, all because he waited. He would have lost out on 10 years of being protected, and it would have cost him thousands of dollars more in the long run. The message is crystal clear. The best time to buy life insurance was yesterday. The second best time is today. And what about a smoker? This is the single biggest health-related price factor. If Mark were a smoker, his $50 a month policy could easily jump to $150 or even $200 a month. That's 3 to 4 times the cost. Insurance companies see smoking as a massive risk, and they price it accordingly. If you're a parent who smokes, quitting is not just the best thing you can do for your health. It's also one of the best financial decisions you can make for your family's security. So you see, it's not some mysterious, unknowable price. It's a calculation based on real, understandable factors. And for the vast majority of parents, it is overwhelmingly, shockingly affordable. The peace of mind that comes from knowing your kids will be okay no matter what is not a luxury item. It's a fundamental part of a solid financial plan, and it costs less than your monthly cable bill. We've shattered the price myth. You now know that you can afford to protect your family, but affordability is just one piece of the puzzle. The next, and arguably more confusing piece, is choosing the right type of policy. Term, whole life, universal life. It sounds like a different language. In the next part, we're going to translate it for you so you can make the single best choice for your family's future. So let's translate this. At its core, the life insurance world is a battle between two big ideas: term and permanent. Think of it like deciding where to live. You can rent an apartment or you can buy a house. Both give you a roof over your head, but they work in fundamentally different ways, and they're for different stages of life. Let's start with renting. This is term life insurance. It is the simplest, purest, and by far the most affordable form of life insurance on the planet. And for most parents, it is almost always the right answer. Here's how it works. You choose a term, which is just a length of time, usually 10, 20, or 30 years. You also choose a coverage amount, say $1 million. You pay a fixed monthly premium for that entire term. If you pass away at any point during those 20 or 30 years, your family gets the $1 million tax-free. If you're still alive when the term ends, the policy simply expires. It's done. You got the protection you paid for, and now it's over. Some people hear that and think, wait, so I could pay for 30 years and get nothing back? And the answer is yes, absolutely. And that's a good thing. That means you lived. You don't buy car insurance hoping to get in a wreck to get your money's worth. You don't buy homeowner's insurance hoping your house burns down. You buy it for the peace of mind, for the protection against a financial catastrophe if the worst happens. Term life insurance is exactly the same. It is a tool designed for a specific job, to replace your income and cover your biggest debts during your most vulnerable years. Think about it. When do you need life insurance the most? It's when you have a 30-year mortgage, 2 young kids who need to go to college, and decades of your career ahead of you. A 30-year term policy is designed to perfectly match that 30-year window of massive financial responsibility. By the time the policy expires, the house is paid off, the kids are grown and independent, and hopefully, you've built up your own savings and investments. The need for that giant safety net has passed. Because it's so simple and has no complex investment features, it is incredibly cheap. A healthy 35-year-old can often get $1 million of coverage for 20 years for less than the cost of their monthly Netflix and Spotify subscriptions combined. Now let's talk about the other option, buying the house. This is permanent life insurance. The most common type you'll hear about is whole life. Just like the name says, this policy is designed to cover you for your whole life. It never expires. As long as you keep paying the premiums, your family is guaranteed to receive a death benefit, whether you pass away at age 45 or 105. But this permanency comes at a huge cost. A whole life policy can be 10, 20, even 30 times more expensive than a term policy for the same death benefit. So why would anyone pay that much more? Because whole life isn't just a death benefit. It's 2 things bundled into one product. It's life insurance and it's a savings account. A portion of your massive premium goes to cover the cost of insurance, and the other portion goes into a savings component called the cash value. This cash value grows over time at a very modest, but usually guaranteed, interest rate. It grows tax-deferred, and after many years you can borrow against this cash value or even surrender the policy to take the cash out. Salespeople will often pitch this as a fantastic forced savings plan. They'll say you're not just throwing money away like with term insurance, you're building equity. And while that's technically true, It's an incredibly inefficient and expensive way to save money. The fees are high, the rate of return is typically very low compared to simply investing in the stock market, and for the first several years of the policy, most of your premium is eaten up by commissions and fees, so your cash value grows at a glacial pace. Think of it like buying a house where the first 5 years of your mortgage payments go almost entirely to your realtor's commission instead of building your equity. That's essentially how many whole life policies are structured. So we have renting, which is term, and we have buying a house with a very conservative, fixed-rate mortgage, which is whole life. But there's a third category that's like buying a house with a more complex, flexible, and sometimes risky mortgage. This is universal life insurance. Universal life, or UL, is also a type of permanent insurance, so it's meant to last your whole life and it has a cash value component. But its main feature is flexibility. Unlike whole life, where your premium is rigidly fixed forever, universal life allows you to adjust your premium payments within certain limits. If you have a great year financially, you can pay more into the policy to build up your cash value faster. If you hit a rough patch, you might be able to pay less or even skip a payment and let the policy's cash value cover the cost of the insurance for a while. You can also sometimes adjust the death benefit. This flexibility sounds great, but it comes with a mountain of complexity. The cash value in a universal life policy doesn't grow at a guaranteed rate like in whole life. Instead, its growth is often tied to changing interest rates or, in the case of a very popular and heavily marketed variation called Indexed Universal Life, or IUL, its growth is tied to the performance of a stock market index like the S&P 500. Sales pitches for IULs are incredibly seductive. They promise stock market-like returns with no downside risk. They'll show you illustrations of your cash value soaring over the decades. But the devil is always in the fine print. These policies have caps that limit your upside, participation rates, and complex fees that can drain your returns. If the underlying costs of insurance rise more than expected, or if the policy's cash value doesn't perform as projected in those glossy illustrations, you could find yourself in a situation where you have to pour thousands of extra dollars into the policy just to keep it from lapsing and becoming worthless. It introduces market risk into the one financial product that is supposed to be your ultimate safety net. So what's the verdict for you as a parent? For 95% of families, the answer is clear, and it's what most independent financial advisors will tell you. Buy term and invest the difference. Let's put it in real numbers. A 30-year-old dad might get a $1 million 30-year term policy for about $60 a month. A whole life policy with the same $1 million death benefit could easily cost him $800 a month. That's a difference of $740 every single month. The buy term and invest the difference strategy says you take that affordable $60 term policy to protect your family. Then, you take the $740 you saved and you invest it yourself. You fully fund a Roth IRA. You contribute to a 529 plan for your kids' college education. You invest in a simple, low-cost S&P 500 index fund. Over 30 years, that $740 a month, earning a conservative market average return, would grow to be well over $1 million. You would end up with both the insurance protection you needed and a massive nest egg that you control completely. With the whole life policy, you'd have a much smaller cash value, locked behind layers of fees and restrictions. Permanent insurance isn't a scam. It just serves a very different, very niche purpose. It can be a tool for multimillionaires to manage estate taxes, or for parents of a child with special needs who will require financial care for their entire life. But for the average American parent trying to protect their family and build wealth, bundling your savings with your insurance is almost always a losing proposition. Your insurance should be for protection. Your investments should be for growth. Keep them separate. Okay, so you've decided term life is probably the right fit. But for how long? 10, 20, or 30 years? And for how much? 500,000? $1 million? 5 million? Picking the right numbers is the next critical step, and getting it wrong can be just as bad as picking the wrong policy. In the next part, we're going to break down the exact formula to calculate your perfect coverage amount and term length, taking all the guesswork out of it. So let's build that formula. But I want you to forget about calculators and spreadsheets for just a second. Instead, I want you to picture a house. This isn't just any house. It's your family's financial fortress. Right now, you are one of the main pillars holding up the roof. If that pillar is suddenly removed, we need to make sure the entire structure doesn't come crashing down. Calculating your life insurance coverage isn't about numbers. It's about building new, permanent pillars that will stand strong, no matter what. Now, you've probably heard the old rule of thumb. Get 10 to 12 times your annual income. Simple, it's easy to remember, and for most families it is dangerously fundamentally wrong. That advice is like a doctor prescribing the same pill to every single patient, regardless of their symptoms. It completely ignores the reality of your life. It doesn't know about your $300,000 mortgage. It doesn't know you have 2 kids who dream of going to college. It doesn't account for your spouse's income, or lack thereof. And it completely ignores the 5-figure car loan you just took out. 10 times your salary is a guess. And your family's future is far too important to be left to a guess. We're going to use a much smarter, more personalized method. Think of it as a custom blueprint for your family's fortress. The easiest way to remember it is with the acronym DIME. That's DIME. It stands for debt, income, mortgage, and education. This is the core framework we'll use to build a number that is real, accurate, and tailored specifically to your family. Let's start with D for debt. This is the first thing we want to obliterate for your family. We want to wipe the slate clean. Grab a piece of paper and list every single non-mortgage debt you have. I'm talking about car loans, student loans, credit card balances, personal loans, any money you owe to anyone. The goal of this portion of the death benefit is to hand your loved ones a check that says, all of this is gone. Forever. No more monthly payments draining their bank account when they are at their most vulnerable. Total all of that up. That's your first number. Next up is I for income replacement. This is the biggest piece of the puzzle. The 10 times your salary rule tries to do this, but it's clumsy. We can be much more precise. The real question isn't how much you make in a year. It's how many years your family will need that income if you're gone. The most common milestone parents use is the year their youngest child turns 18, or even better, graduates college around age 22. So look at your youngest child's age. How many years until they are out of the house and financially independent? Is it 15 years? 18? 20? Take that number of years and multiply it by your current annual take-home pay. So if you bring home $60,000 a year and your youngest is 3 years old, you'll want to replace that income for at least the next 15 years. 60,000 times 15 is $900,000. That's your income replacement number. It's designed to ensure the lights stay on, groceries are bought, and life can continue with the same financial rhythm they're used to. Now for M, the mortgage. For most American families, this is the single largest debt they have. Imagine the profound peace of mind your family would have if, in the midst of their grief, they learned they would never have to make another mortgage payment again. That the house they call home is theirs, free and clear. This is one of the most powerful gifts you can give them. It's not just a house, it's stability. It's knowing they won't have to move, that the kids won't have to change schools, that their roots can stay planted. So look up your current mortgage balance. The full remaining amount. Write that number down. Finally, E for education. This is the one people often underestimate. We all want to give our kids the best possible start in life. And for many, that includes the option of a college education without being saddled by crippling debt. The future cost of college can be staggering. A safe, conservative estimate for a 4-year degree at a state school in the future is around $150,000. For a private university, you could be looking at $250,000 or more. So decide what kind of legacy you want to leave. Pick a realistic number you'd want set aside for each child's education, and add it to the total. For 2 kids, that might be $300,000 right there. So now you have D, I, M, and E. Add them all together. Debt plus income replacement plus your mortgage plus education costs. This is your core coverage amount. For many of you, that number is already over $1 million, and that's okay. That's normal. That's what it actually costs to protect a family. But we're not quite done. I like to add a plus to the DIME method. A little extra cushion for the things people forget. First, final expenses. Funerals are expensive, easily $10,000 to $20,000, not to mention any final medical bills. It's wise to add another $25,000 to your total just for this. The other critical plus is the value of a stay-at-home parent. If you have a spouse who stays home to care for the children, their work has immense economic value. If they were to pass away, the surviving working parent would suddenly have to pay for daycare, cleaning, cooking, and coordinating everything. That could easily cost $50,000 or more per year. You absolutely need a policy on a stay-at-home parent that reflects this cost, using the same income replacement formula we discussed earlier. Let's walk through a quick example. Let's meet the Jacksons. They have a $300,000 mortgage. They have $40,000 in combined car and student loans. They have 2 kids, ages 4 and 7. The primary earner makes $75,000 a year. Let's calculate their need. D for debt is $40,000. I for income is $75,000 for the 14 years until their youngest turns 18. That's $1,050,000. M for mortgage is $300,000. E for education is $150,000 for each of their 2 kids. That's $300,000. Let's add a plus of $25,000 for final expenses. So we have $40,000 plus $1,050,000 plus $300,000 plus $300,000 plus $25,000. The Jacksons' total need is $1,715,000. They probably need a policy for $1.75 or even $2 million. Does that number sound huge? Yes. Is it the right number? Absolutely. It's not an exaggeration. It's the reality of what it takes to make a family whole. Okay, that's the coverage amount. The second magic number is the term length. How long should the policy last? This is much simpler. Your policy's term should last as long as your biggest financial responsibilities. For parents, that usually means 2 things: raising your kids and paying off your house. Look at those 2 milestones. When will your youngest child graduate from college? When will your mortgage be paid off? Whichever of those dates is further in the future, that's your target. If your mortgage will be paid off in 23 years, but your youngest will be out of college in 20 years, you need a term that covers you for at least 23 years. Since insurance is typically sold in 5-year increments 10, 15, 20, 25, 30 years, you would round up. In that case, you'd get a 25-year term policy. Don't make the mistake of getting a 20-year policy to save a few bucks, only to have it expire 3 years before your biggest debt is gone. Protect your family for the entire journey. So you have your number. Your personalized, custom-built coverage amount and term length. It might seem huge, maybe even a little scary. You might be looking at a $2 million 30-year term and thinking there is absolutely no way you can afford that. But what if I told you that securing $1 million fortress for your family could cost less than your weekly takeout order? In the next part, we're pulling back the curtain on the real cost of term life insurance. We'll reveal the key factors that determine your price, and I'll share a few insider tricks to help you get the absolute lowest rate possible. Alright, let's talk numbers. Because that's the real question, isn't it? We can talk about peace of mind and protecting your family all day long, but at the end of the day you need to know, what is this actually going to cost me? Is this a new car payment kind of expense? Or a couple of fancy coffees a month kind of expense? I'm happy to tell you that for most healthy parents, it's firmly in the latter category. In fact, you will probably be shocked at how affordable it is. The price of life insurance can feel like a total mystery, a number spit out by some secret computer in a basement somewhere. But it's not a mystery at all. It's a science. It's a highly calculated assessment of risk. The insurance company is making a bet. They're betting that you'll pay your premiums every month and live a long, healthy life past the end of your term. You, on the other hand, are making a bet that if the unthinkable happens, they'll be there to pay out a massive life-changing sum of money to your family. To figure out the odds of that bet, they look at 4 main categories: your age, your health, your lifestyle, and the details of the policy you want. Let's break down each one, because understanding this is the key to unlocking the lowest possible price. First and most importantly is your age. This is the undisputed heavyweight champion of pricing factors. Every single birthday you have, the base cost of a new life insurance policy goes up. It's not a huge jump from 32 to 33, but the jump from 35 to 45 is significant. The reason is simple and a little blunt: the older you are, the statistically closer you are to, well, the end. An insurance company sees a 30-year-old as having a very, very low probability of passing away in the next 20 or 30 years. A 50-year-old? The risk is higher. This is why the single best piece of advice anyone can give you is to buy it when you're young and healthy. You are locking in a rate based on your younger self for the entire term. Waiting a year can cost you. Waiting 5 years will absolutely cost you more, potentially thousands of dollars over the life of the policy. The second major factor is your health. This is where the infamous medical exam comes in. Now, don't let this scare you. For most people, it's a simple 20-minute appointment. A paramedic comes to your house or office at your convenience. They'll check your height and weight, take your blood pressure, and collect a blood and urine sample. That's it. They're not looking for perfection. They're looking for a clear picture of your overall health. From that data, they're looking at things like your cholesterol levels, blood sugar, liver function, and for the presence of nicotine or other drugs. This information, combined with your medical records, places you into a health classification. Think of it like a credit score for your body. The better your score, the lower your price. The top tier is usually called Preferred Plus or Super Preferred. This is for the marathon runners, the people whose health stats are pristine. Then you have Preferred, for people in excellent health but maybe with one or two minor issues like slightly elevated cholesterol that's well controlled. Below that is Standard Plus and Standard, which is where a huge portion of the population lands. This is for generally healthy people who might be a little overweight, have well-managed blood pressure, or a family history of a specific illness. And even if you have more significant health issues like well-controlled diabetes or a history of cancer, you can still often get coverage. It just might be in what's called a substandard or table-rated class, which adds a percentage surcharge to the standard price. The key takeaway here is that you don't have to be a super athlete to get a great rate. You just need to be managing your health. The third factor is your lifestyle. This is all about the choices you make every day. And the single biggest lifestyle choice that impacts your rate is tobacco use. Using tobacco, whether it's cigarettes, cigars, or vaping, will instantly double, triple, or even quadruple your premium. It is the most expensive habit you can have when it comes to life insurance. A 35-year-old non-smoker might pay $30 a month for a policy. The exact same person, if they smoke, could be looking at $120 a month. That's over $1,000 extra every single year. Insurers also look at other lifestyle risks. Do you have a history of DUIs or a long string of speeding tickets? That signals risky behavior. Do you have any dangerous hobbies? Things like scuba diving, private piloting, or mountain climbing can add a small, flat extra fee to your premium. It doesn't mean you can't get covered. It just means the company needs to account for that added risk. Finally, the fourth factor is the policy itself. This is straightforward. The more coverage you buy, the more it will cost. A $2 million policy will cost more than a $1 million policy, and the longer the term, the more it will cost. A 30-year term policy will have a higher monthly premium than a 20-year term policy for the same person. Why? Because the insurance company is on the hook for 10 extra years, which increases the overall probability that they might have to pay out the claim. So age, health, lifestyle, and policy details. Those are the 4 pillars of your price. Now for the good stuff. How do you game the system? How do you get the absolute lowest rate? I've got 4 insider tricks for you. Trick number 1, the quit smoking hack. If you're a smoker, you're going to get smoker rates. But here's what most people don't know. You're not stuck with them forever. Most insurance companies will allow you to apply for a rate reduction after you've been completely nicotine-free for at least 12 months. You'll have to go through a new medical exam to prove it, but making that change can literally slash your premium by 50 to 75%. It's a massive financial incentive on top of the obvious health benefits. Trick number 2, use an independent broker. This is maybe the most important tip I can give you. There are 2 types of insurance agents. Captive agents who work for one single company, like State Farm or Northwestern Mutual. They can only sell you their company's products. Then there are independent brokers. They're like a travel agent for insurance. They work with dozens of different companies. Why does this matter? Because every insurance company looks at your health and lifestyle a little differently. One company might be really tough on people who are slightly overweight. Another might not care about your weight but is very strict about family history of heart disease. A third might offer the absolute best rates for someone with well-controlled anxiety. An independent broker's job is to know which company will view your specific profile most favorably. They shop you around to find the perfect fit, which can save you hundreds if not thousands of dollars. Going with a captive agent is like walking into a Honda dealership and asking them to find you the best car. They're only going to show you Hondas. Trick number 3, the annual pay discount. It's a small one, but it's free money. Almost every insurance company charges a small administrative fee for processing monthly payments. If you choose to pay your premium once a year instead of 12 times a year, they waive those fees. This typically results in a discount of about 5 to 8%. On a $50 a month policy, that's an extra $30 or $40 in your pocket every year, just for checking a different box on the form. And trick number 4, this is a bit more advanced, the laddering strategy. Most people think they need one big 30-year policy, but your financial needs change over time. Your biggest need for coverage is in the early years when your kids are little, your mortgage is huge, and you have no savings. But 20 years from now, your mortgage might be paid off and your kids might be out of college. You don't need as much coverage then. So instead of buying one big 30-year, $1 million policy, you could ladder multiple smaller policies. For example, you could buy a $500,000 policy for 30 years, another $250,000 policy for 20 years, and a final $250,000 policy for just 10 years. For the first 10 years, you have a full $1 million in coverage. For the next 10 years, as one policy expires, you have $750,000. And for the final 10 years, you have $500,000. This approach tailors your coverage to your needs as they decline, and it can be significantly cheaper than buying one monolithic policy. So let's put some real numbers to this. A healthy 35-year-old woman, non-smoker, looking for a $500,000, 20-year term policy. She can realistically expect to pay somewhere between $25 and $35 a month. That's it. For $500,000 of protection, a healthy 35-year-old man for the same policy might be closer to $30 to $40 a month. Now, what if that same woman waits until she's 45? That same policy could now easily cost her $60 to $80 a month, just because she waited. The cost of waiting is real. The price of life insurance isn't a black box. It's a predictable calculation based on who you are. And now you know the rules of the game, and more importantly, you know how to play it to your advantage. You have the knowledge to control the variables you can, and to find the best possible deal for your specific situation. So you understand the factors, you have the tricks to get the best price. But who can you trust? With hundreds of companies out there, all claiming to be the best, how do you sort through the noise and choose a rock-solid company that will actually be there for your family if they ever need it? That's the critical next piece of the puzzle, and it's exactly what we're breaking down in the next part. Okay, so you've done the hard work. You've figured out why you need life insurance, you've calculated how much coverage your family needs, and you've decided between term and whole life. You're standing at the 1-yard line, ready to score this major win for your family's financial security. But this last step, choosing the actual company, can feel like picking a single grain of sand on an endless beach. There are hundreds of them, all screaming for your attention, all claiming to be the best. But here's the unvarnished truth. The company you choose is not just a detail. It is, quite literally, the foundation of the entire promise. A life insurance policy is only as good as the company that writes it. This isn't like picking a brand of cereal where if you get it wrong, you're just out $5. This is a multi-decade promise, a financial bedrock you are laying for the people you love most, to be delivered at what will likely be the worst moment of their lives. So, how do you make sure that promise will be kept? How do you choose a company that is not just a business but a fortress? We're going to break this down into 3 core pillars. Think of it as a 3-point inspection for any insurance company you consider. Get these 3 right and you can sleep soundly knowing you've made a rock-solid choice. Pillar number 1, and this is non-negotiable, financial strength. Imagine you hire a builder to construct a hurricane-proof shelter for your family. You wouldn't hire a guy working out of the back of his truck with a rusty hammer, right? You'd want to see his credentials, his past projects, the quality of his materials. You'd want to know he builds things to last. A life insurance company's financial strength is the exact same thing. It's their ability to withstand financial hurricanes, recessions, market crashes, pandemics, and still be standing strong to pay out claims, not just next year but 30, 40, or 50 years from now. A policy from a shaky company isn't worth the paper it's printed on. So how do you check this? You don't need to be a Wall Street analyst. You just need to know where to look. There are independent rating agencies, financial watchdogs, whose entire job is to kick the tires on these insurance companies. The big ones you need to know are AM Best, Moody's, and Standard & Poor's. AM Best is the one most people in the industry focus on. They give letter grades just like in school. An A++ or A+ is superior. An A or A- is excellent. A B++ or B+ is good. My personal rule of thumb, and one shared by many financial advisors, is to not even consider a company that doesn't have at least an A- rating from AM Best. You are looking for excellence, not just adequacy. You want the company that has a massive surplus, that has managed its investments wisely for decades, that has a proven history of weathering storms. Think about it. There are companies out there that have been operating for over 150 years. They've paid claims through the Civil War, the Great Depression, 2 World Wars, the dot-com bust, and the 2008 financial crisis. That kind of longevity isn't an accident. It's the result of disciplined, conservative, long-term management. That's the kind of company you want to entrust with your family's future. So step 1 before you even look at a price quote is to Google the company's name and AM Best rating. If it's not in the A range, cross it off your list and move on. No exceptions. Pillar number 2, the human experience. This means customer service and, most critically, the claims process. Financial strength is the bedrock, but this is the part that determines what your family will actually go through if they ever have to use this policy. Let's play out two scenarios. Scenario A. The unthinkable happens. Your spouse, already shattered and overwhelmed, has to make the call. They're put on hold for 45 minutes. They get transferred 3 times. They're told to find a specific form online, print it, fill out 12 pages of confusing jargon, get it notarized and mail it in. A week later, they get a letter saying a box was checked incorrectly, and they need to start over. The process drags on for months, adding immense financial and emotional stress to an already unbearable situation. Now scenario B. The unthinkable happens. Your spouse makes one phone call. They speak to a compassionate, dedicated claims specialist who walks them through every single step. The specialist says, "I am so sorry for your loss. My only job is to make this as easy as possible for you. I'm going to fill out most of this for you. I just need to confirm a few details." The necessary paperwork is minimal and sent overnight with a prepaid return envelope. A check arrives for the full amount in a matter of days, not months. Which scenario do you want for your family? The company you choose determines which one they get. So, how do you judge this ahead of time? First, you can look at industry-wide studies, like the J.D. Power U.S. Individual Life Insurance Study. They rank major insurers on customer satisfaction. Second, and this is a powerful tool, you can check a company's complaint record. Every state has a Department of Insurance, and they all report to the National Association of Insurance Commissioners, or NAIC. The NAIC maintains a National Complaint Index. Here's how it works. An index score of 1.0 is exactly average for a company of its size. A score below 1.0 means they get fewer complaints than their peers. A score of 0.5, for example, means they get half as many complaints as the average. A score of 2.0 means they get double. You're looking for companies with a complaint index consistently below 1.0. It's a direct, data-driven measure of how well they treat their policyholders. A low complaint index combined with a high J.D. Power score is a powerful indicator that you're dealing with a company that prioritizes people, not just profits. Finally, pillar number 3, the right fit for you. This is where the nuance comes in. A company can be financially strong and have great customer service, but still not be the best choice for your unique situation. This is all about their underwriting process and policy offerings. Underwriting is the process the insurance company uses to evaluate your application and decide how much of a risk you are. They look at your age, your health, your family medical history, your occupation, and your hobbies. And here's the key. Every company has its own secret sauce, its own underwriting guidelines. This is incredibly important. Let's say you have high cholesterol, but it's well controlled with medication. Company A might look at that and say, "No problem, you qualify for our best preferred plus rate." Company B, with stricter guidelines, might say, "That puts you in our standard rate class, costing you 50% more for the exact same coverage." Company C might even deny you altogether. The same goes for everything. Some companies are more favorable for people with well-managed diabetes. Others specialize in coverage for private pilots or scuba divers. Some are more lenient if you have a family history of cancer. There is no single best company for everyone. The best company is the one that looks most favorably on your specific health and lifestyle profile. This is also where riders come back into play. Does the company offer a robust accelerated death benefit rider for chronic or critical illness? Do they have a waiver of premium rider that makes sense for your occupation? The policy itself needs to be tailored to your potential needs. So how on earth are you supposed to know which company is the best fit? You can't. Not on your own. This is precisely why working with an independent broker or agent is so crucial. A captive agent works for one company, say State Farm or Northwestern Mutual. They can only offer you their products. An independent agent, on the other hand, works for you. They have access to dozens of different insurance companies. Their job is to be the matchmaker. They know that for a 45-year-old with sleep apnea, MassMutual or Protective might offer the best rates. They know that for a 30-year-old who enjoys mountain climbing, Prudential might be the way to go. They do the shopping for you, submitting your profile to multiple A-rated carriers to see who will give you the best offer. Using a good independent agent costs you nothing extra. They're paid by the insurance company, but their expertise can save you thousands of dollars and, more importantly, get you placed with the right carrier for your situation. So let's recap the 3-point inspection. 1. Financial strength. Look for an A- or better from AM. Best. 2. The human experience. Check the NAIC Complaint Index and JD Power Ratings. 3. The right fit. Work with an expert who can match your personal profile to the company with the most favorable underwriting. Nailing all 3 of these ensures that the piece of paper you buy is more than just a policy. It's a promise backed by a century-old fortress, a compassionate process, and a tailor-made fit. You've now selected your target. You know the company you want to work with. Now comes the actual process of applying. It can seem intimidating: the application, the medical exam, the waiting. What really happens behind the curtain during underwriting? How can you prepare to get the absolute best possible outcome? We're going to pull back that curtain and walk you through every single step, demystifying the entire application process from start to finish. Alright, let's break down this black box of underwriting. Think of it less like a scary, mysterious judgment and more like a final exam where you're allowed to study beforehand. The insurance company's goal is simple: to accurately understand your level of risk. Your goal is to present the most accurate and hopefully favorable picture of that risk. The entire process from application to approval is just a conversation to get to that point. It all starts with the application itself. This is your opening statement. It's a detailed questionnaire, and I know nobody loves paperwork, but every single question has a purpose. They'll ask about your age, your height and weight, your income, and your net worth. They'll dive deep into your medical history, any past surgeries, chronic conditions, or medications you're taking. They'll also ask about your family's medical history, specifically your parents and siblings, looking for hereditary conditions like heart disease or cancer at an early age. Then come the lifestyle questions. Do you smoke or use any nicotine products? This is a huge one, and they don't just mean cigarettes. Vaping, patches, chewing tobacco, it all counts, and it can double or even triple your premium. So, if you've recently quit, that's fantastic, but you need to be honest about when your last use was. Most companies want you to be nicotine-free for at least a year, sometimes longer, to qualify for non-smoker rates. They'll also ask about your hobbies. Are you into scuba diving, rock climbing? Or do you have a pilot's license? These are considered avocations, and they can add risk. It doesn't mean you'll be denied, but they might add a flat extra fee to your premium to account for that specific activity. Be completely 100% honest on this application. The single biggest mistake you can make is trying to hide something. It's not a memory test, but intentional misrepresentation is fraud, and it can lead to your policy being voided later on, which is the absolute worst-case scenario for your family. If you're unsure about a date or a detail, it's better to say you're unsure than to invent an answer. Once the application is submitted, the next step for most people is the medical exam. This is where a lot of anxiety comes from, but it's really straightforward. The insurance company will arrange for a paramedical examiner, a licensed medical professional, to meet you at a time and place of your convenience. It can be your home, your office, first thing in the morning, whenever works for you. The whole thing usually takes about 20 to 30 minutes. They'll reconfirm some of the application questions, take your height and weight, check your blood pressure and pulse, and collect a blood and urine sample. That's usually it. For older applicants or those seeking very large policies, they might also do an EKG, but you'll be told that in advance. Now, here is the most valuable advice I can give you for this entire process. You can and should prepare for your medical exam. This isn't about cheating the system. It's about ensuring the results reflect your true, baseline health, not a random, unflattering snapshot. For at least 24 hours before your exam, and ideally 48, you want to do a few things. First, drink plenty of water. Being well hydrated makes it easier to draw blood and can help flush your system. Second, avoid strenuous exercise. A heavy workout can elevate your liver enzymes and protein levels in your urine, which could be misinterpreted as a sign of kidney or liver issues. A light walk is fine, but don't go run a marathon the day before. Third, watch what you eat. Avoid foods high in salt and fat, because they can temporarily spike your blood pressure and cholesterol readings. Think of that greasy bacon cheeseburger or a huge bag of salty chips. Save it for a post-exam celebration. Also avoid poppy seeds. Yes, really. They can, in some cases, trigger a false positive for opiates. Sounds crazy, but it happens. Fourth, avoid alcohol and caffeine. Both can dehydrate you and raise your blood pressure. And finally, try to get a good night's sleep and schedule the exam for the morning. You'll be in a fasted state, which gives the most accurate cholesterol and glucose readings, and you'll likely be your most relaxed, leading to a better blood pressure reading. Following these simple steps can literally be the difference between a standard and a preferred rating, saving you thousands of dollars over the life of the policy. Okay, so the application is in, the exam is done. Now the file lands on the desk of an underwriter. This is the person whose job it is to put all the puzzle pieces together. They are the detective in this story. They'll take your application and your lab results, and then they'll start verifying. First, they will pull a report from the MIB, which stands for the Medical Information Bureau. This is not a detailed medical record. Think of it more like a credit bureau for the insurance industry. It's a database of codes that insurance companies use to share information. If you previously applied for life or health insurance and disclosed a specific condition like sleep apnea or a heart murmur, the MIB will have a code for that. The underwriter uses this to make sure the information on your new application matches what you've disclosed in the past. It's a consistency check. Next, they'll run a prescription history check, sometimes called an RX report. They can pull a record of all the medications you've been prescribed over the last 5 to 7 years. This is incredibly revealing. If you said you're in perfect health but they see a prescription for insulin, that tells them you have diabetes. If you're on a powerful antidepressant, that tells them about your mental health history. This is often where those little white lies on the application get exposed. If you're taking medication for high blood pressure or cholesterol, you absolutely must disclose that. The prescription history will show it anyway, and it's far better to be upfront about a managed condition than to look like you were trying to hide it. For many policies, they'll also pull your motor vehicle report or MVR. They're looking for a pattern of risky behavior. A single speeding ticket from 3 years ago? Probably not a big deal. But multiple DUIs, a history of reckless driving, or a suspended license. That paints a picture of someone who takes significant risks, and it will absolutely impact your rates, or could even lead to a decline. The underwriter takes all of this information, your application, the exam results, the MIB report, the prescription check, and the MVR, and they put it all together. They are trying to place you into a specific risk category. These categories have names like Preferred Plus, Preferred, Standard Plus, and Standard. Preferred Plus is for the super healthy, the marathon runners with perfect blood pressure and family history. Standard is for the average person, maybe a little overweight or with managed high cholesterol. There are also substandard or rated classes for those with more significant health issues. Each class corresponds to a different price. Their job is to figure out which one you belong in. Finally, after all that analysis, which can take anywhere from a few days to a few weeks, you get a decision. There are a few possible outcomes. The best case, you're approved as applied for, at the rate you were quoted. Great. The second possibility is an approval at a different rate. Maybe they uncovered something that bumped you from preferred down to standard. You'll get an offer with the new price, and you can choose to accept it or decline it. The third outcome is a postponement. This might happen if you just had a major surgery or are in the middle of a serious diagnosis. They'll want to wait 6 months or a year to see how things stabilize before they'll reconsider. And the last outcome, of course, is a decline. This is rare, but it happens for very serious health conditions or a pattern of high-risk behavior. So that's it. That is the entire journey from application to offer. It's not a mystery box. It's a methodical process of information gathering and risk assessment. And by being honest, thorough, and preparing properly for your exam, you put yourself in the driver's seat to get the best possible result. Now you have the offer in your hands. You've navigated the maze, you've passed the tests. But the journey isn't quite over. What happens next? How do you actually accept the policy and put it in force? And, most importantly, what are the critical mistakes people make right after getting approved that can jeopardize everything you've just worked for? We're going to cover that and complete your entire life insurance playbook in our final part. So you've done it. You navigated the quotes, you chose a policy, you aced the medical exam, and you got the email. You're approved. The policy is officially in force. What does that even mean? It means the contract is active. It means if the unthinkable happened tomorrow, the insurance company is legally bound to pay the death benefit. It's the moment the promise becomes real. But this isn't the finish line. This is the starting line of a marathon, and what you do from this point forward determines whether that promise actually protects your family. The most devastating mistakes aren't made during the application. They're made in the years that follow, when complacency sets in. The first and most common mistake is treating your life insurance policy like a gym membership you bought on New Year's Day. You sign up with the best of intentions, set up the auto-pay, and then completely forget it exists. This is the set it and forget it trap, and it's a huge gamble. Your life is not static. It changes, grows, and becomes more complex. The policy you bought to protect a family of 3 in a starter home with a $200,000 mortgage might be dangerously inadequate 5 years later when you're a family of 4 in a bigger house with a $500,000 mortgage and skyrocketing college costs on the horizon. Inflation alone erodes the value of your death benefit. $1 million policy today won't have the same buying power in 20 years. That's not pessimism, it's just math. The solution isn't to panic. It's to schedule a policy review. Put it in your calendar. Every 2 to 3 years or after any major life event, a new baby, a new home, a significant raise or promotion, starting a business, pull out that policy. Look at the coverage amount. Look at your life. Do the numbers still add up? Is the fortress you built still big enough to protect the kingdom you have now? Often the answer is no. But because you're reviewing it, you can make adjustments. You can purchase a supplemental policy or explore other options. Forgetting to do this is like building a great wall, and then never checking for cracks as your city expands beyond its borders. The second critical mistake is far simpler, and somehow far more tragic: messing up the payments. You would be shocked at how many policies lapse, meaning they become void, because of a missed payment. People spend months getting the perfect policy, pay premiums for 10 years straight, and then it all evaporates because a credit card expires, or they switch checking accounts and forget to update their auto draft. The grace period for a missed payment isn't forever. The insurance company will send notices, but in our world of digital spam and overflowing mailboxes, it's terrifyingly easy to miss them. Here's your action plan for this. First, if possible, pay annually. Many companies offer a small discount, and it reduces your chance of a payment mishap by a factor of 12. Second, if you must pay monthly, set it up as an automatic transfer or ACH from a primary checking account, not a credit card. Credit cards expire and get replaced. Checking accounts are far more stable. Third, set a calendar reminder for 1 week before your payment is due. A simple pop-up on your phone that says "Confirm life insurance payment" is a 5-second task that can save your family's future. It's a tiny hinge that swings a massive multi-million-dollar door. Don't let that hinge get rusty. Now for the third mistake, and this is where things can get legally nightmarish. I'm talking about beneficiary blunders. The beneficiary is the person, people, or entity you designate to receive the money. Getting this wrong can send your final gift into a black hole of legal fees and family conflict. Blunder number 1. Naming a minor child directly as your beneficiary. You cannot legally give $100,000, let alone $1 million, directly to a 10-year-old. If you do this, the court will have to step in. A judge, a stranger, will appoint a financial guardian to manage that money until your child turns 18. This process is slow, expensive, and can drain a significant portion of the funds in legal and administrative fees. More importantly, it takes control away from the people you would have wanted to manage the money, like your spouse or a trusted sibling. The correct way to do this is to name a trust as the beneficiary, with your children as the beneficiaries of that trust. Or, at a minimum, to use the Uniform Transfers to Minors Act, or UTMA, which allows you to name an adult custodian for the funds. Blunder number 2. Forgetting to name a contingent beneficiary. The contingent or secondary beneficiary is who gets the money if your primary beneficiary can't. Imagine you and your spouse, who is your primary beneficiary, are in a car accident together. If you pass away and your spouse passes away a day later, and you have no contingent beneficiary listed, where does the money go? It goes to your estate. And that means it has to go through probate court, a lengthy, public, and costly process that can lock up the money for months or even years, right when your children or other heirs need it most. Always name a contingent beneficiary. Blunder number 3, the one that makes for dramatic TV movies. Forgetting to update your beneficiaries after a life change. The most common example is divorce. If your ex-spouse is still listed as the primary beneficiary on your policy, guess who gets the money when you're gone? Your ex-spouse. It doesn't matter if you're remarried. It doesn't matter if you have new children. The beneficiary designation on that policy is a legally binding contract. Supersedes your will. This is not an exaggeration. It happens all the time. After a divorce, a marriage, or the death of a named beneficiary, your absolute first stop should be to review and update your policy. The final mistake is perhaps the most heartbreaking. It's the mistake of being a secret agent. You do everything right. You buy the perfect policy, you fund it diligently, you update the beneficiaries, but you never tell anyone about it. You put the documents in a safe deposit box or a folder in the back of a filing cabinet, and the key or the knowledge of its existence dies with you. A life insurance policy is a worthless piece of paper, if your loved ones don't know it exists or can't find it. The insurance company isn't going to magically know you've passed away and come looking for your family. It is on your beneficiaries to file a claim. So your final piece of homework is to create a legacy file, or a just-in-case binder. In it, you put a copy of your life insurance policy, the company's name, the policy number, and the contact information for their claims department. Then you tell your spouse, your parents, your adult children, or the executor of your will exactly where this file is. You have to break the taboo of talking about this stuff. You say, "Hey, I love you, and because I love you, I've done this. If something ever happens to me, here is the playbook. Open it." And that's what this has all been about, creating your family's financial playbook. We started by confronting the tough why. We calculated exactly how much you need, not just a guess. We demystified term and whole life. We walked step by step through the application and the medical exam. And now you know how to manage your policy for the long haul, avoiding the traps that sabotage so many well-intentioned people. You have the complete guide. This isn't about planning for death. It never was. It's about planning for a life that will continue. It's about ensuring that the people you love most will never have to face a financial crisis on top of an emotional one. It's about making sure your kids' dreams of college don't die with you. It's about making sure your partner doesn't have to sell the house your family calls home. In the end, life insurance is one of the most profound and selfless acts of love and responsibility you can take as a parent. It's a promise written in ink and backed by capital that says, "No matter what happens to me, you will be okay." You now have all the tools you need to make that promise. Go and build your fortress.